Good day, ladies and gentlemen, this is Professor Ma. In our previous episode in this series, Professor Ma explained why diversification is currently the best investment strategy. We did this by looking at the Norwegian Sovereign Wealth Fund, the best performing sovereign wealth fund in the world. We were able to do this because all investments made by the Norwegian Sovereign Wealth Fund are transparent and publicly available on its website, regardless of whether one is a Norwegian citizen. From the information, it is evident that the Norwegian Sovereign Wealth Fund closely follows the diversification strategy. However, as an individual investor, we would not be able to diversify to the same extent as the Norwegian Sovereign Wealth Fund. At the individual level, one of the simplest methods of diversification is to buy exchange-traded funds, or ETF. An ETF is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs will track a particular index, sector, commodity, or other assets, but unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. An ETF can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. ETFs can even be structured to track specific investment strategies. The first ETF was the SPDR, S&P 500 ETF, which tracks the S&P 500 index, and which remains an actively traded ETF. Today, ETF share prices fluctuate all day as the ETF is bought and sold. This is different from mutual funds, which only trade once a day after the market closes. ETFs can contain all types of investments, including stocks, commodities, or bonds. ETFs offer low expense ratios and fewer broker commissions than buying the stocks individually. One of the safest investment choices would be investing in the Straits Times Index ETF, which tracks the Straits Times Index. There are currently two such ETFs, namely the Nikko AM Singapore STI ETF, G3B, and SPDR STI ETF, ES3. Both ETFs track the index by creating a fund that invests in its component stocks. At this juncture, Professor Ma would like to state that I do not earn any commission should any viewer decide to purchase the ETFs. Professor Ma is merely using the ETFs as examples. In subsequent videos, Professor Ma will explain more aspects of life. Please help by liking and by subscribing. Thank you.